Welcome back. In this episode, we are going to address the question, what is the 4% rule in the financial services industry? And with what I'm going to teach you, it reminds me of this cartoon that I have here on my wall, which I actually purchased the art for this clear back in 2007 when my third book, Last Chance Millionaire, was released. It became a New York Times, Wall Street Journal #1 bestseller. And it shows this couple here. The husband is working on his computer on the couch, and this is his wife, and it says, if we take a late retirement and an early death, we'll just barely squeak by. Sometimes that's all too true for some people when they're looking towards retirement. And one of the problems is this 4% rule in the financial services industry. So I want you to learn in this video about how to not outlive your money and not have to deal with that 4% rule that the industry broker-dealers force upon their advisors so that they won't be sued for you running out of money. I'm Doug Andrew, and I've been an author of 13 books is my goal by the end of this year. And my 11th book is titled The Laser Fund, and I'll show you at the end of this episode how you can get a free copy of this. I'll fire it out to you. You just pay a nominal shipping and handling fee. But this isn't about trying to sell you a book. I'm going to give it to you. In the financial services industry, which I've been involved with for more than 4.5 decades, I've noticed that a lot of people that have their money in the market, because most people put their money in, tax-deferred IRAs or 401ks in the market. And this is like the market EKG. And I've often described in my books, the stock market is like a person with a yo-yo, hopefully walking up some stairs. But it goes up and down, up and down, up and down. And this is from 1960 to the year 2010. That was a horrible dip that we experienced in 2008. So in looking at that, it helps us understand, golly, if you're just told to hang in there, what is your average rate of return going to be? Well, you're going to be shocked when you see the difference between investor rate of return, the actual rate of return investors have, versus the investment return if you bought and held. Now, I often quote Warren Buffett because he had 2 rules of investing. Number 1 is don't lose money, and number 2, don't forget rule number 1. Easier said than done, right? Well, let's look at the actual research. Cresmont research says that from a 50-year time period, from 1960 to 2010, if you were to look at like the S&P 500, now that's the Standard & Poor's 500, it's a measuring device of the top 500 companies in America. That's an indicator whether the market is up or down and whether you probably made money or lost money in any given year and what your average was. And Cresmont said if you eliminate 100% of the losses over that 50-year period. Now, most decades, if you just moved in 10-year chunks, most decades will have an average of 7 up years, gain years, compared to 3 loss years. There are periods like 2000 to 2010, there were 5 loss years and only 5 gain years. And our clients more than doubled their money during that time period when most people were barely back to break even. But what Cresmont said is, you know what, if you just eliminated those loss years, you didn't make any money, but you didn't lose them. They said you'd only need 25% of the upside gains to actually beat the market. Do you understand that? If you eliminated the lost years, you only need 25% of that. So if the market went up 20, you only earned 5, okay? That means that as the market goes up, you only need 25%. If it went up 20, you only earned 5%, not 25. You would outperform the market if you just got rid of the lost years. Well, how do you do that? That's why I'm so passionate about a concept called indexing, because you eliminate the loss years. You don't lose when the market goes down, but you make money when the market goes up. And Cresmont is the one that says you'll outperform the market if you do this. Now, most financial advisors, how do they make their money? They make their money based upon you buying and selling. See, the more they churn your money in the market, the more fees they generate. And so that's one of the reasons why they say, oh no, why would you want to pass up this huge gain period of time? Well, it's because I want to eliminate the loss years. You can participate when the market goes up and not lose when the market goes down when you use indexing, and we teach this in other episodes. And so it's really interesting. I mentioned Dalbar in several of these educational episodes. Dalbar has tracked investor behavior and its impact on return. So this was a 20-year period ending in 2012, I believe. And they said, you know what, if you just bought and held, you should average in a 20-year period around 9.14%. But most investors are not averaging 9.14% because they're not buying and holding. If you earn 9 and you had $1 million saved, that would be $90,000. But you pull out $90,000 out of a tax-deferred IRA or 401k, you're only going to net $60,000 because 1/3 of that goes out the window in taxes, usually for most retirees. But this is where they said, oh, in this time period, it was 3.83 was the actual investor return. They had to revise that down to 3.49 the next year. So it's around 3.5% to 4%. Now that means why? Why is there a difference between this and this? Because investors get emotionally involved, and when the market starts going down, they finally go, ugh, and they get their money out of the market, and then they wait till the market comes back up, and they miss all that upside, and they finally buy in. So they're selling low and buying high, and that is not smart to be able to do that. And so what happens is the average return is only about 3.5%. So this is what precipitated the 4% rule in the financial services industry. As a financial strategist for 45 years, helping people with their hard-earned money at retirement to create predictable rates of return, I wanted to get people's money out of the market and put it into a strategy in indexed universal life insurance contracts that could net people 7, 8, 9, 10% internal rates of return tax-free after the cost of the insurance and all fees. But let me show you the impact of the 4% rule in the financial services industry. Let's say that you needed $3,000 a month on top of Social Security, or maybe you taught school, or you had a defined benefit pension, or whatever. So you need $3,000 a month to make ends meet, which is $36,000 a year. Now, in order to net $3,000 a month or $36,000 a year out of a tax-deferred IRA or 401k, most people would have to withdraw at least $50,000 out of that IRA or 401k to net $36,000. Why? Because you have to pay tax. So you have to pay tax on that. Now, that's only 28% between federal and state tax. Many people pay as high as 33%, or in California, 40%. If you have to withdraw $50,000 out of an IRA or 401k to net $36,000, what is $50,000 4% of? It's $1,250,000 nest egg. Does that shock you? If you're anything like me, I don't accumulate $1,250,000 to have a measly $3,000 a month to buy gas and groceries or golf green fees or whatever. That's pathetic. But see, that's the 4% rule. If you had $1,250,000 and it was out there in a portfolio of IRA 401ks in the market, most financial advisors are forbidden from illustrating any type of a predictable income. But if you do want to take income, they are limited to 4%. This is the 4% rule. We recommend you only take out no more than $50,000 on that, 4% of that. If you take out more than 50, they know you might outlive your money. And so you have to sign this waiver that you will not sue them for outliving your money if you take more than 4%. Isn't that pathetic? And so that's the 4% rule, and people go, oh golly, I only can pull out 50 to net 36, and I have $1,250,000. So my favorite vehicle that I use is a max-funded insurance contract. I call it the LASER fund in my books, and LASER is an acronym that stands for Liquid Asset Safely Earning Returns. In this book, I show that historically, by using indexing, you can earn rates of return averaging 7%, 8%, 9, 10. I've actually averaged 11.17, and I've netted 10.07 for the last 25 years by using indexing and rebalancing. And so those two strategies are taught in my books, but what does this mean? If you earned 8% and you had a payout of 8%, 8% on $1,250,000 is $100,000. How much better is $100,000 than $50,000? It's double, okay? It's 100% more. But see, this $100,000 in the laser fund is tax-free. This one is only tax deferred, so you're only netting 36. How much better is $100,000 of income versus 36,000 to buy gas and groceries, haircuts and so forth? But actually, by using two strategies, indexing and rebalancing, there are many periods that I have earned 10%. Most people that I've educated and that work with our savvy financial advisors who understand how to do this correctly, they've been earning or being able to have 10% payouts. So when you have a 10% payout on $1,250,000, that's $125,000, tax-free. What would you rather have? $36,000 or $100 or $125? I would guess $125. If you want to learn how to do that, I would strongly recommend you learn about indexing strategies, how to reposition that money in your IRAs or 401ks using what we call strategic rollouts, where you convert your hard-earned money from this kind of an environment with a pathetic 4% rule and increase it to 8 or 10% payouts without depleting the nest egg. The 4% rule, if they're only earning 3.5%, will slowly deplete it. In my laser fund, it does not deplete the nest egg. Hopefully, this is giving you some insights into opportunities that maybe you didn't know existed before. And so this is what motivated me to become an author, and I've written 11 books. My goal is to write a book every year, minimum, for the rest of my life. But all of my books empower the reader to be able to take ownership of their brighter future with strategies like what I've just explained, because it is so much better, double, triple what the financial services industry says you can only pull out 4% because we don't want to be sued, and that's because of the actual rate of return due to market volatility and because you have to pay tax on where most people have their money. And they thought they were going to be in a lower bracket, and they're not. And so my most recent book is called The Laser Fund, and this is actually two books in one because I found a lot of couples. One learns sometimes more left brain. They like the charts and the graphs, so there's about 200 pages, 14 chapters of charts and graphs and explanations. But if you are a numbers person, you flip the book over and you read this one. This is about 12 chapters that contain 62 actual client stories and examples of how this works. And so however you like to learn, if you want to use your whole brain, right and left brain, you can read both of these. I would love for you to get a copy. If you go to laserfund.com, you just cover the shipping and handling fee, very nominal, and I will fire one of these out to you immediately. And there'll be options in there for you to get the audio, the digital version, little mini classes and so forth if you want. But my goal is to empower you, not trying to sell you a book. I want you to have the education, the ability to be able to dramatically improve your retirement income and cash flow by double or triple what the financial services industry says that you're stuck with at a 4% payout. So welcome to your brighter future as you learn.